Welcome to the Institute of Economic Affairs 21st webinar of the year. This webinar is being held under the auspices of the Economic Regulation and Competition Policy Program here at the IE, one of the 6 programs we have. Now, the topic of the day is on the pensions sector, and we're trying to look at basically the proposals that were held, or Fuller, please mute, that were put within the finance bill that was rejected, and how those would have impacted the pensions industry in the country. So by way of introduction, I'll just state a few things just to give a stepping stone for our key presenter, whom I'll introduce in the course as I end my brief introductory remarks. Now, the pension industry in Kenya has experienced significant growth over the last decades. And of course, we know that the pension industry plays a crucial and critical role, more so for the retirees in terms of providing some sort of financial security, which enables them to continue with their daily lives, even after the employment period or upon retirement when they reach the stipulated age. Now, we have different types of pension schemes in the country. We have the public sector, and of course, occupational we call private sector, and there are also individual pension plans. For the public sector, these are covering those civil servants, your teachers, and of course, military personnel, the police, if you may say. For the private sector, we have just employees in the private sector whom have their own pension schemes which take care of, which actually are geared towards enabling them have some cushion at times in the time when they retire. And individual ones are more so geared for those who are not either in the public or private, but have their own sort of arrangement where they contribute on a monthly basis to some defined contribution scheme, after which they reap the benefits thereof in good time. Now, in the past few years, we've had a couple of challenges in the pension schemes, in the pension industry rather, as a whole. Notably, by a few organizations, we've noted that in Kenya, there's still low coverage or awareness levels on exactly what pension schemes actually do. And the other issue is that there are some issues on which border on technology, and definitely issues that border on the regulatory changes that we've seen over the years on the different types of pension schemes. So for today, our key issue is actually to look at what were the proposed changes in the rejected finance bill, and to do that, we have a speaker of the day, Mr. Crispin Oduma. So as he loads his presentation, let me just make up a few remarks on Crispin. Crispin Oduma is an expert in the pensions industry and a senior consultant, of course, an advisor for retirement schemes at Zamaro, Kenya. He has a wealth of experience, having been with the ICA for over a period of over 10 years, so to speak. So he's well versed in matters of pensions and retirement benefits schemes, being also an administrator in his own capacity, having also being a certified trustee for that matter. So Mr. Crispin, kindly, as you load your presentation, you can begin and let us know what are the lowdowns that were proposed and how those would have impacted the pension sector in Kenya, and what you propose moving forward for the sector. Crispin?
Thank you very much, Stephen. As has been said, my name is Crispin Oduma, and I have worked in this sector for now over 15 years. And first of all, let me thank you so much for inviting me to partner with you. You are a very respected think tank in the region, and to partner with you is a privilege, so that we can improve knowledge for policy interventions here and there in our economy. And therefore, having asked me to talk about the growth in our retirement benefits sector, and particularly to look at what were the interventions that were proposed in our finance bill that was aborted, I will focus particularly on the taxes that were meant to intervene in inciting excitement for growth that would have been in the sector. But before that, I would want to just highlight areas of possible growth. How would a retirement sector grow? One, a retirement sector grows from one, if more people, or when more people contribute to a retirement scheme, a registered scheme. When more people contribute to a retirement scheme, then there is potential growth in the extra contributions. When the same people contribute more or could make a higher contribution to a retirement scheme or to retirement schemes, then there will be higher contributions than usual. So again, there is a chance or opportunity for growth. Three, when the fund managers or when the investment managers give higher returns, then again, there is opportunity for growth in that area. We would experience growth when what we have contributed on higher returns. So we have three areas. One, when more people or more new people make contributions, that is when employers hire more people, or when we have increased number of employers, and so we have new schemes coming up, new people making contributions to registered schemes, then we expect the sector to grow in terms of the bottom line. Two, when we have the same people making higher contributions because they have higher disposable income, then we expect growth. Then three, as I stated, is when we get higher returns because of a better investment decisions. So among those three, the first one, which I stated, that when we have new employers and therefore new people making contributions, new schemes coming up, that is not happening currently. That has not happened in the last few years because of limitations in employment. So employers are no new schemes are coming up because of economic challenges. So then we are left with two, when the same people make higher contributions and when the investment money are organic causes for growth in the retirement sector. Organic causes of growth in the retirement sector. That means higher contributions by the same people and higher returns. Now, the government of Kenya thought that to intervene and make more people Even if we are not employing new people, we are not putting together new schemes to aid growth from outside, we could make the same people contribute higher levels of higher levels of contributions from make higher levels of contributions from their salaries. So they made interventions for contributions, they made interventions for returns to incite you and me to make contributing into a retirement scheme and a priority. So contributions by individuals, that's employees and employers, on behalf of the employee to a registered retirement scheme or fund are allowable for tax deduction naturally. And I'll get into this in the next pages or slides. Up to 20,000 has always been allowed for tax exemption at payroll level. This has been there since for more than 20 years now. And as a sector, we have been pushing that this be raised because 20,000 is kind of very little if it is the only that amount that's allowed to go out there to fetch for you the most returns. It's very little. Of course, there would be taxes at withdrawal depending on your age, but the government has been allowing up to 20,000 into a retirement scheme that's registered untaxed. Up to 20,000 untaxed. Then when it goes into the scheme, the returns on it has always not been taxed. So there is exemption at contribution, there is exemption at investment, but then there would be tax at withdrawal depending on age and reasons for exit or for retirement or reasons for leaving the scheme. So I want to explain where we are in terms of taxes in retirement schemes for individuals and for corporates. And then I will bring in what were the proposed interventions and what would have been their impact. So that's why I'm stating currently that government allows up to 20,000 into a retirement scheme untaxed. This means that an individual member of a retirement scheme is allowed by government to put into a retirement scheme or inspired by a government through taxes or through a tax exemption to try not to put money elsewhere but into a retirement scheme because it would not be taxed. So at payroll, they would remove the 20,000 that you have put into a retirement scheme before they tax you payee. So some people call it pay, but payee is a tax on your salary. So the monthly tax on your salary would not be charged on the 20,000. In this way, the government incites me or you or helps me and you to put at least that 20,000 into the scheme. Now, not all of us are able to contribute that 20,000 all the time. Because, for example, if your trust deed allows 10% and your 10% is just 10,000, you'd need some more inspiration to contribute more than 10,000. Otherwise, you'd only contribute what you are able, which is just that 10,000. And the law of the scheme also allows that just that 10,000. So to go to the next level and contribute more than 10,000, you need an intervention. I'll get to that. So contributions are tax deductible up to 20,000. Investment income, I said that this 20,000 gets into the scheme. The investment income does not get taxed. And when we are withdrawing, this is different because then this would depend on how long I've been in the scheme and what are the reasons for my exit. If I am leaving at retirement, the tax is different. If I'm living, when I'm less than 50, the tax is different. So when you're withdrawing, so at contribution, the government allows you up to 20,000. When you're withdrawing, if you are 50 and below, the government would charge you more. So the government would charge you harshly to allow you to retain the money in the scheme until when you actually need it. That means when you turn 50 and above. The minimum retirement age in Kenya is 50 years, but most retirement schemes have the normal retirement age at 60. So it means that if this investment was meant, this long-term investment was meant for retirement, then it would be appropriate to hold your money in the scheme up to when you actually turn 60 and leave employment. Then this money is meant for the purpose that was created for it. But you realize that people change jobs and ask for this money. So the government, in its own wisdom, would hit you hard if you ask for your money just because you have changed jobs, or if you ask for money because you have left employment and you're still less than 50. But before they charge you harshly on your benefits, the government would give you a benefit of up to 60,000 per year that you have been in the scheme for the number of years you have been in the scheme, up to a maximum of 10 years. So assume you have been in the scheme for 12 years, full years or complete years. At the computation of your retirement benefits or your exit benefits, we would calculate the benefit, but take out 600, which is 60,000 per year by 10 years, and give you that free of tax. So that has been there. That tax benefit has always been there. So there is a benefit at contribution, there is a benefit at investment, and there is a benefit at exit. Again, there's another benefit at exit. If I'm above 50, the tax bracket changes. It changes to a wider one that's more relaxed because I'm approaching senior citizenry to the government then with the acknowledgement that I've paid a lot of taxes, make sure that I go home with a little more. But then the real deal comes when you hit 65. Currently, when you hit 65, all your benefits will be computed and given to you free of any taxes. Absolutely free of any taxes. But how many people would be so patient to leave their benefits in a retirement scheme up to 65? Very few. Because when you leave employment, there are new needs and there's excitement to try your hands in projects here and there, and maybe you just need that money. So this is where we are. This is where we are currently, that there are benefits at contributions, there are tax benefits at investment, there are tax benefits at withdrawal, depending on the age, the age at which you leave the employer or the scheme. All these have not been enough, and people, we have, as consultants in the area, we have realized that people are not so excited. People are not so excited to put more money into retirement schemes. When you are training members of a retirement scheme on invitation by the employer, you do realize that very few people come because they're not excited. They want today's money. And they would ask you normal questions are, but even if I'm not taxed today, that 20,000, I'll be taxed anyway. At the end of the day, the tax will come, and it might come at a point when I actually really need that money. So most of it will be taken away, but I need the money. So why would I defer taxation today? Why would I defer taxation today as a way of feeling good and think that then I will enjoy later when I know that it will actually come? Well, I would rather be given I would rather be given 10,000, be allowed by somebody to give out 10,000 to go out and invest so that I get the most with it. That if my salary was 100,000, for example, and the government allows me to put out to give 20,000 untaxed, and they would tax me later on at withdrawal. And even at that withdrawal, there are chances that I would not be taxed if I was to be patient enough up to 65, or if I was to be patient enough to ask for my money from age 50, where I would enjoy a preferential tax advantage. You see, the more money you go out today to search for opportunities, the better for you. So the saying that I would be taxed anyway is a good excuse, but it's not good enough. It's not good enough because a tax advantage is better when it is taken. If it's not taken, then it's not realized. If it's not realized, it means nothing. So I always urge members of retirement schemes to take advantage of these tax benefits, however little they may be. If you leave a scheme currently at age 50, below age 50, let me just go back a bit. Yeah, below age 50, then you would be taxed more aggressively. The tax band would be the first part of your benefits, I said, would be given free up to 60,000 per year for the number of years you've been in the scheme, to a maximum of 10 years, a total of 600,000. Then what remains would be taxed at first 288 of those benefits that remain would be charged at 10%. Then the next 100,000 of your benefits would be charged at 25%. Then the rest would be charged at 30%. That is a very aggressive band for taxing someone who has saved over the years. That taxation is very, very aggressive. You would notice that, you would know that if you compare it to this one. I want you to compare it to this one. I wanted to explain this, that currently, if you're patient enough to ask for your retirement benefits after you have been in the scheme for 15 years, or you have been in the scheme and you are over 50 years, so either you have been in the scheme for 15 years or you are over 50 years, then the tax band relaxes compared to the earlier one. I explained that if you take your money at a younger age, younger than 50, the government would punish you literally by charging you aggressively. The government would charge you tax aggressively to discourage you from taking money meant for retirement early in your years. So the first of your benefits, first of all, we would compute your benefits and give you 60,000 every year up to a maximum of 10 years, which is a maximum of 600,000 tax-free. That's a current benefit on your tax advantage, tax allowed on your benefits. After that, what remains we would charge at first 288 of what remains of your benefits would be charged at 10%. Next, 100,000 at 25%, and above that, we will tax you 30%. I stated that this is a very aggressive tax band, but it is for a purpose. The reason is to discourage you from taking your money, because you can leave this money here or you can transfer it to another scheme without taking it, so that it delays up to until you reach at least 50 years. So the government used tax to discourage you. It can use tax to encourage you or to discourage you. So here it uses it to discourage you from picking your money that's meant for retirement when you are still younger than 50. because you will end up being a social problem to the government, and the government will have to pay you that 4,000 monthly later on. Yet you have worked for so long. So let's go to the alternative tax that then the government uses to entice you to leave money in the scheme or transfer the money without taking it, so that you only pick it when you are above 50. That is the one that is pension tax bonds 2. Here, you will be given the first 600,000. If you have been in the scheme for more than 10 years, you will be given 60,000 per year, up to 10 years for free. Then the next one, what remains will be charged at 400 for 10%. The next 400, 15%. You see, this one is lower, takes more of your benefits and charges it with a lesser tax percentage. So there's an advantage in delaying accessing your benefit. So the government has used tax here to entice you to delay accessing your benefits, so that you access it when you need it most, when you are much older and are not able to hustle around and get alternative opportunities. I want you to listen to the way I've used those 2 tax bands, that the government can use tax to discourage you. The government can use tax to entice you. So the first band is used to discourage you from accessing benefits. When benefits are not accessed, the scheme grows. Your own fund value grows, because it will grow with returns at the end of the year that will be declared by the fund manager. It will grow by new contributions if you bring in. Remember, if you leave a retirement scheme and you leave your money, your benefits will continue growing at the same rate as those of members who are still actively working in that company. So it's important to know that if the government uses tax to discourage me from picking my money, I will leave the money there. I will leave the money there, and the money will grow. And when it grows my fund value, and it grows the scheme, and it grows the sector bottom line. So an opportunity for growth here, using tax, 2 tax bands used for different purposes, and just meets the purpose depending on what the member understands from those 2 tax bands. So that I wanted that to come out very clearly. Now, after having brought that, Stephen, move to finance bill proposals.
We are there. Proceed.
You're there. Very good. Now, the first opportunity, the first tax advantage that government gave, according to what I've given you so far, was at contribution, where the government gave you up to 20,000 every month, 240,000 every year, tax-free, to be allowed to go into the scheme for investment, and returns on it not taxed also. It would only meet tax later on. So the government proposed to raise this 20 to 30,000. How would this impact your scheme? It means that a member would be excited to put in more, sacrifice more of his salary to go into the scheme, because it will not be taxed payee, it will not be charged payee. So this tax, this 10,000 in excess that the government now allows you, or was going to allow you, was going to be exempted from payee. It wouldn't be charged payee. So at payroll, you are 10,000 over and above the 20,000 the normal would not suffer payee. It would go into the scheme. Returns on it would not suffer corporate tax at 30%. So you have enjoyed 2 benefits already. You would have enjoyed 2 benefits already. You'd have enjoyed pay, lesser pay on your salary, and no corporate tax on your returns. That would be more, because the amount going out as capital is greater, therefore it's likely to fetch higher returns. So this was going to excite people to do more additional voluntary contributions. This was going to excite members of retirement schemes to do more additional voluntary contributions, because they would save on their pay and also corporate tax. At the same time, they would earn higher returns. So you see there that growth opportunity, it means that my fund value as a member of the scheme at the end of the year would be higher, would grow, because I put in more, having been excited by government intervention. Two, the scheme to which I belong would have a greater bottom line, because the fund value, my individual fund value grows, the scheme's fund value grows. One, by higher contributions. Two, by higher returns. Right? It then means that the sector's bottom line, because the sector right now is slightly below 2 trillion. If many members, including those who are members of the Institute of Economic Affairs, Staff Provident Fund, were to contribute 10,000 more, just because of that tax advantage, it means that the number of billions would clock the 2 billion immediately or so. So the sector growth was going to be more rapid just with this one item. It didn't happen. Two, we were going to be allowed, let me just move this.
We can hear you, just go ahead.
Can you hear me?
Yes, yes. Please go ahead.
Yes. Okay. Two, we were going to be allowed to ask for our benefits. If you ask for your benefits above age 50, you wouldn't be taxed at all. Now remember that 50 years, that's 65 years, when we say that at 65, you would withdraw free of charge. This was going to be deleted. This was going to be deleted, and it meant that members would now be excited to put more money into the scheme, so that when they ask for the money from age 55 or 50 towards age 60, when they now retire from employment, they would ask for their money untaxed. Now that was a problem, because if someone who was 50 was charged at the same rate as someone who was 60, that 400,000 band was applicable from age 50 to age 60. It didn't matter whether you were 51 or 59. The tax band was the same. You have saved all your life, you have been paying taxes, you're now 60, you stop working, but when you go home, whatever benefits you have saved that have accumulated were still taxed, even though at a lower rate, but they were taxed. Particularly if you had a huge amount of money, over 10 million, you would experience the tax at a very high amount or high levels. Now, this was going to be deleted. The tax enjoyment, complete tax enjoyment, which has always been at 65, was going to be applicable from age 55 going up. So everyone would be excited. 55 is not too far. People would save more, would put more money into the scheme, because they would just take it without tax. The other thing was that if you retired on ill health, remember today, you're taxed if you ask for your money because of ill health. You're taxed. It's only that it's a preferential tax. So instead of being taxed at that 288 bracket, you would be taxed at, you are currently being taxed at 400. So it's preferential, but you're taxed. The finance bill proposed that this be abolished, so that if you ask for your money because you are ill and you cannot continue working, you should be paid without tax at all. So it would compute your benefits and give you. This would excite anybody because it's like taking an insurance. I would put more money in such a protected vehicle. It's like a protection. It's like insurance that if something happens to me and I can't work anymore, I'd take the whole money. But if I know that however much I put in there, if something happens to me, they'll still tax me, and they'll tax me maybe aggressively against my wishes. So I would put money in an alternative investment that I think would not attract so much tax. So here, again, the government was going to give us such a big advantage because you can be ill at any age. You don't have to, you cannot choose the age to which you get ill. But you would not, we would only compute your benefits and give you the whole amount. Then the next one, if you were in a scheme, for 20 years, you have worked for an employer for 20 years and you have been in that scheme for 20 years, you would enjoy a tax-free benefit. That was the other advantage that was going to be given by the tax, by this so-called finance bill that was abolished, that was abandoned. So you see, currently, what we enjoy is a preferential tax advantage when you have been in a scheme for at least 15 years. You will be taxed, but you'll be taxed at that wider bracket. So there's tax, but at a lower amount. This time round, they were proposing that once you have been in a scheme for 20 years and above, and you leave the employer, and you ask for your money, there will be no tax. We'll pay you everything. That would incite people to put more money into the schemes. Now, there are companies that still pay gratuity. There are companies that still pay gratuity, particularly in industrial area. You go there, people are not making contributions to retirement schemes. The employer promises to give you an amount when you leave. Now, this was proposed to enjoy tax advantage, so that if you are receiving a gratuity and you want to transfer it to a pension scheme, it would enjoy a benefit which today is 240 per year untaxed to 360,000 per year untaxed. In simpler terms, this is what it means. That if I have a gratuity of, let's say, 1 million, and I want to transfer it to a scheme, the scheme cannot accept a gratuity. The retirement scheme will only accept a contribution. So the contribution to the scheme should be exempt 20,000 Kenya shillings currently, up to 20,000 Kenya shillings should go into the scheme untaxed. Now, when the government proposed to give you 30,000, it means that the gratuity that my employer is giving me and I want to transfer it to a retirement scheme, I'll break it down to 30,000 per month instead of 20,000 per month. It's that 30,000 per month that is totaling to 360 per year, untaxed, so that it enjoys pay, it goes into the scheme, it enjoys tax-free investment returns. And of course, when I will ask for it, I'll enjoy tax depending on the age, my age, and the number of years I've served in the scheme, served the employer and been in the scheme. The other advantage that was going to be removed right now, those of you who have been trustees, you may know that you could be running a scheme that is not tax exempt. So these exemptions we are talking about, are only enjoyed if they are registered, if the scheme is registered with KRA as a tax exempt scheme. That's the position currently. That you register a scheme with RBA, but again, you have to go and register it with KRA for exemption. So there has to be specific exemption, and an exemption certificate has to be issued to the scheme. For these exemptions we have been talking about to be enjoyed, tax advantages to be enjoyed. So the government was going to remove this requirement to double register, which means register with RBA and again register with the KRA. It was supposed to be automatic that once I register a retirement scheme with RBA, the scheme should be exempt from everything else that is required as exemption from KRA. It should reflect in government portals, that is KRA, all the other authorities. Immediately, I registered it with the RBA. This again was lost. There has been this fund that is invested parallel with the retirement benefit schemes. It's called Post-Retirement Medical Fund. So that when I am still working, I save parallel to my retirement fund, I save an amount that would help me buy insurance for medical purposes when I'm above 60 and out there retiring, enjoying my retirement. Because insurance companies literally reject old people. They become a higher risk because they are expected to die sooner. You see, insurance companies do not want to give you a medical cover and then every day you are in hospital. You become a serious risk to their business. And you see, old people are thought to be those kind of risks that would be in hospital every day. So the government realized that however much they allow people to save in retirement schemes, this amount is used majorly, not in enjoyment, but in protection of retirees through medical payments. So you live with 10 million, but every day you are in hospital to manage arthritis, to manage what, the money is depleted. So it doesn't help you. You don't enjoy retirement. You only take money to hospital. So the government advised through RBA and put structures in place so that members of retirement schemes, employees, can contribute into that retirement scheme for an amount that would grow in parallel with the retirement benefits to be accessed when you leave the scheme for medical purposes. Now, this was not enjoying tax exemption. So the finance bill proposed that that up to 10,000 monthly be tax exempt for this purpose. It meant that me and you would be excited to put money in there. Why? Because again, this would enjoy payee exemption. So look at this. Going into the same retirement scheme, I have been allowed 30,000 same month, not charged pay. Then there is this 10,000 not charged. So a total of 40,000 would go into the scheme without pay. So it means that they will deduct from my salary. They will deduct 40,000 before they charge pay. That's a huge tax saving. Currently, it's only 20,000. So a total of 20,000 would be added through the finance bill. That did not work. So you see, there were good intentions. There were good intentions for the pension sector, because if this 10,000 for post-retirement medical is also invested in this same scheme, because it's invested in the same scheme, it's only that it's reported differently so that there is no mix-up at access. This one would only be accessed when you retire so that you use it to buy medical insurance cover. The other one is your retirement benefit, but they grow. If this 10,000 was not allowed before, people would not be excited to make that contribution to the scheme. So it means that currently, nobody is really excited by this post-retirement medical scheme because there's no tax advantage. So the government, on introducing this, thought that we would be excited and we would sacrifice more and put more monies into retirement schemes for retirement purposes and for post-retirement medical purposes, and therefore grow our retirement account fund value at the end of each year as we invest. We would be excited to put in now 30,000 other than 20,000. Instead of 20,000, we put in 30,000. This excitement translates into a higher fund value for the member, a higher fund value for the scheme, a higher sector value at the end of the year. We would not be talking about 1.5 trillion or 2 trillion. We would rapidly grow into a bigger sector in terms of fund value. So this was all not realized, but I heard that the minister, the CS for Treasury, Honorable Mbadi, mentioned on TV recently that these are some of the things that he wishes to bring back through Parliament, because there were good things in there. Particularly as a practitioner in this sector, I feel that these are advantages that I want to enjoy today, because look at it this way. As a think tank, you talk about inflation as eating into people's disposable income, and therefore hurting people's future lives, because then you can't save more if you're spending more on buying current basic goods. If an employee has to suffer from higher inflations or from inflation, and the employee does not get tax breaks like the one that were proposed here, it means that my salary will be too depressed. My salary would be too depressed that thinking of any long-term saving is not in my mind. When that happens, I would only contribute what is minimum and what is required by the trust deed as an employee. If it is 5%, nothing additional. What ends up happening is that I work for 30 years, but I leave the employer with a greater incidence of poverty, because I leave the employer speaking great English, but I cannot afford my own life. I cannot sustain my own life. So I have spoken English throughout 40 years, 30 years, working in a big institution with a good name. But because I've been saving only minimums, I go out there, what becomes my replacement income cannot meet my needs then. So the income replacement ratio, which we call IRR, the income replacement ratio, which basically means that I have stopped working, I'm 60, I have stopped working. The next month after my 60th birthday, I am retired, and I should earn a salary that is commensurate with the needs of the time. The needs of the times are retirement times. There would be higher incidences of medical needs. There would be so much. These days, you are actually even raising kids because your children are not getting jobs, yet they are giving birth. So they give birth and they bring these children home, and you have to raise them with your retirement benefits. So your retirement benefits become so depressed so that you do not live long enough. And if you live any longer, then you live longer, unable to sustain your life, and you become a problem to government and to everybody. Therefore, I want to tell you that there were opportunities that would have improved growth in this sector at individual contributors level, at corporate level, because when your members save more, and are excited, you also get an advantage. The environment is exciting. You also have a chance to use your retirement scheme to attract better employees. There was going to be the sector growth in terms of fund values. We would be talking of 2 trillion or so. And the rapid growth of the sector, there would be better employment, there would be excitement in this. All that would have come if these items were absorbed in the government laws and adapted as our laws in the sector. We missed them, but the good thing is that the new CS thinks that they are good things and has suggested that it's going to bring them back. I want to stop there. I wanted to focus on tax as an item that can be used, a tool that can be used, and that were meant to be used by this bill to excite us to save more in the sector and to grow the retirement benefits sector. Thank you very much. And if there are any questions, I would want to engage more.
Thanks, Mr. Crispin Oduma. I think you've done justice to the topic of the day. And without much further ado, perhaps I just want to say two or three things that I think stuck for me. And one of the things is that, of course, the way to grow is to either have more people contributing or the same people contributing more, or as well as you mentioned that in terms of returns, then when those are higher, then that would actually lead to growth of the pensions sector or industry for that matter. And the proposals, I think I also agree with them personally, where if the finance bill passed as it were with these proposals, then I think for me we would have the improvement from 20 to 30K would have meant, of course, that if you keep that with your pension scheme for a while until your retirement age, and based on the returns that you've agreed upon and the stipulated rules within the trust deed and rules, then at the end of it, you benefit more. But I think the most important thing is that were it to go through, then if you are to have that pension and to withdraw it at 55, which is actually not far for some of us, then that would be actually a welcome move. So as we've heard from the latest developments, of course, the CS is looking into these issues. So let's see how that pans out in due course. I would like to hand over this to my colleague Fiona Okadia, who perhaps also has some few things to say and also to take us through the plenary. Fiona?
Thanks, Steve. I think probably we could, before we go to the plenary section, I'm a bit curious if Mr. Crispin, if probably you did the calculations for someone who, for instance, say that their initial pension was 30,000 under the current scheme, and 20,000 was untaxed, and the 10,000 went into the other. I know like the statement has two, unregistered and registered, yeah. And then now that 30,000 will all be accounted for, and this person was to say retire at 60. How those numbers would look in terms of the taxation side, because also I was one of the people who are saying, look, if I'm going to pay taxes, if I'm going to defer the taxes now and pay them later, do you have calculations that show me that this is how much I'm gaining in terms of, say, the amount of money at 60 and now? Because even at 60, my 2 million that I've saved now will not be at the same value at 60 years. So there's that also to take into consideration, even as we're arguing that probably the tax component will be different then. So I think, yeah, so if you've run such numbers, I would really like to look at them. yeah. And then I think I would also like to open it up to anyone who probably has a question or comment as well.
Thank you, Fiona. Just before you bring in the plenary, this is a very good question. You just want to be able to see. I didn't can't lie that I did a computation of any kind. I didn't, but let me paint the picture. That assume you have just been contributing 20,000, which is what goes out of the scheme untaxed. All right, out of your salary and tax, and you continue contributing that 20,000 for the rest of your life, working life, until you're 60, when then you retire on a normal retirement rule. Today, if this proposal was to go through, you would be contributing 30,000. So you saying assume that the you have enjoyed, of course, the pay advantage of that 10,000 extra, because now you're doing 30,000. Then you do your 30,000 until you retire now from today. This is what will happen. The provision, the proposal for withdrawal tax at 60 from this finance bill was that when you reach 60, you would not be charged tax at all. So currently, that 20,000 that you are doing, you do it up to 60, but at age 60, we would tax you. Your administrator would tax you. They would give you, even though your tax would be lower than that person who asked for theirs at an age lower than 50, you would be taxed at that wider band. So what we would give you your, because you shall have been in the scheme for more than 10 years, so you'd give you your 600,000 tax-free, but then the rest we would charge with the second band, which is 400 at 10%, like that to the end. So you see, you would be taxed at 60. But with these new proposals, you would do your 30,000 every month. It enjoys pay free. It goes into the scheme, no corporate tax. You are patient enough. You don't ask for anything, even if you change your jobs. When you turn 60, you ask for your benefits. We will compete your benefits and give you everything without a single tax. So you see, already, if with that picture, you see there's a huge, you would go home with a bigger lump sum if you're in a provident fund than someone who is in the current situation. So that's what we are saying would have given us better growth at individual, better growth as at sector level.
Okay,
Thank you.
Thank you so much. Okay. Is there anyone with a question or a comment? You can just raise your hand, or you can type it out, and then I'll read it on your behalf. Go ahead.
We note that the CS is actually looking into this, but how is it going through this? Is it through a private member's bill, or what is being proposed as the way forward?
Well, I don't know, but that was asked in on that TV session. I really don't know the procedures Parliament, but he said that legislation is a continuous process, and government works through legislative changes. So he said that legislation did not stop with this finance bill being thrown out. So I think he'll propose them through, I don't know whether private or what, but it seems that there are many ways of making sure that good things can still go through. And he's an experienced member of parliament. So for him to say that, I think there's tangibility in his capacity to make this move forward. But something like what you're saying, that parliament has capacity, not through a finance bill like this one, but through another bill, and have it go through. And the minister would apply good things that were thrown out with this.
Thank you.
Yeah.
Back to you, Fiona.
Okay, there's a question from John. He asks, what other issues should the government consider for growing the pension industry?
Good. Generally, thank you. Another very good question, but this one is generally what would government consider in growing the economy? Because you see, pension is a byproduct of growth of pension schemes is a byproduct of growth of general growth of an economy. If we are doing business, remember when Stephen was introducing the session, he mentioned the types of retirement schemes. And one that touched me is when he mentioned personal or individual retirement pension plans. These are plans for people who may not be employed by anybody, they employ themselves. So this thing that you hear of Mama Mboga, Boda Boda, all these people that whose names are flashed around as being low cadre people employ themselves. When I talk about employment, you economists know, when you talk about employment, you just don't mean people who are hired by somebody as a group of employees. No, an individual employing his skills to get an income can save for a future when he would not be able to do the same job in future. So, but for that individual to generate something, the economy, the environment has to allow. If the environment infringes or limits the chances of someone creating even the little that they can do. If you want to open a shop these days, you want to cook mandazi, the kind of licenses that you're asked to register are impeding growth at any level. So if you want to, you just want to cook food for people. For example, go to industrial area. All those people you see walking through Mbagathi Road, all the way to industrial area to work. If you use that road early in the morning, there's a serious number of people walking from Kibera going to industrial area. They go there, they work, they do all that work, but at lunchtime they want to buy something. Somebody needs to give them food. If you go to industrial area and place some bucket of food that would serve such people, Kanjo will come and you would be, they'll take everything you have. So all these requirements, however good for a good environment, infringe on people's ability to generate an income from which they would save for a purpose like retirement. So we're not just talking about retirement in isolation. We're talking about the economy at large. If saving for retirement is a long-term saving, kind of, there is saving in a circle. This same person is expected to save, save for NHIF or the other one that has just come in. Remember, we have been paying 500 for NHIF. How do you pay for 500 if you cannot even generate anything? So there is saving for your medical, which is NHIF. There's saving into a circle so that you can actually borrow from a pool and develop, because retirement schemes don't give loans. You want to borrow so that you can have what they're calling affordable house. So you want to borrow so that you can afford yourself a house, however cheap. You want to build your own house. You cannot build a house if you do not have a good lump sum of an amount. So if the economy is not allowing, it's not expanding, it's not growing, it's not allowing easy, business starting of businesses, however small, we should be allowed to start businesses as much. Of course, there should be regulations, but this uncontrolled fleecing of people's sweat is eating into our ability to save, not just for retirement, but for our life, to feed ourselves. So most importantly, and the first and most obvious answer to your question, how can the government allow us to save more, is open up the economy, allow us to start businesses. Even if someone is not going to employ us, we can employ ourselves. allow us to start businesses with ease. The difficulty with which we are faced to start a business in Kenya is a limiting factor to growth of any kind. If I can't grow, then forget about saving. Don't even talk to me about saving. Ukienda base, if you go to ile base ya mtaani, watu huku wanakula miraa. How do you tell them about saving? How do you tell them about saving and they can't even afford food? So it's upon the government and stakeholders to say less and do more and allow people to generate income, however little, so that from that income, they would save for a future which is not going to allow them to work so hard. Once you turn 60, the knees will not allow you to work. However much you would want to work, the knees will not allow you. There would be all kinds of impediments. So when you're still active, instead of, and you see when a politician calls a rally, even on a Tuesday, the rally is full of who? You know, you cannot leave your office where you're working to go to that rally. So it means that unemployment is a serious problem in the country. So those people who are in that rally, how do you ask them to save? Save from what? You only have to save from what you have earned. So the answer is allow us to start businesses with ease, open up the economy so that opportunities come, excite employers, excite potential employers through tax exemptions so that they can start businesses and allow people to get jobs and save. Otherwise, it's tough even for employers. And when it's tough for employers, it's tougher for employees because they can't get opportunity. And if they get opportunity, they can't save anything out of what they earn. So it's a wide, and I think working with a think tank like Institute of Economic Affairs, this has been the biggest challenge. How do you make people earn more? How do you make people start businesses? Because if they start businesses, they'll save. If they earn more, they'll have a greater capacity to save more. And a country that saves more is a country that has a sustainable future. The word sustainable then comes in, because I can save and then tomorrow I eat. By the way, let me just bring in this thing. You guys, everywhere today, there's this thing called money market. If I'm not wrong, Fiona, you have meant money market everywhere. Money market,
Yes.
money market. Do you know, in my real definition of investment, money market is not an investment. It's a saving. Saving is preserving money. You preserve with an intention. I can preserve my money waiting for, there's this thing called emergency account, where I want to have at least 3 times my salary into an emergency account. So I save to meet the target of 3 times my salary, so that should anything happen around my household as an emergency, I'm able to meet it with liquid money quickly enough. Investment, you save the money and then put it in a pot that gives you real investment. Now, real investment is investment that returns higher than the inflation rate. That's when you get a real return. So you cannot have an investment when the return is lower than the inflation rate. If you check across board, maybe this is an opportunity to research on this noise about money market. The return that is being published, one is gross, meaning the fund managers or whoever the sponsor is has not removed their fees. When they remove their fee, what is the net return? And is that net return higher than the inflation rate? If it is not, and yet it is annual it's an annual return. What is in the papers is an annual gross return. Bring it down to monthly so that you see, if I put money in a money market today, unit trust, for example, and I withdraw it at the end of the month, and I was told there's 14%, there's 10%, there's 9%. Have I actually earned something, or I just gave this money, these people money, to which they are pulled together and made their money with? So this excitement about money market is not an investment. No one should tell you that's an investment. Neither is it a protection. So I would rather spend that money buying an insurance cover just in case the maturity comes or the insurance matures, I got money. You would be told that money market returns higher than a bank. But money market still allows you to access that money as frequently as you want. You'd be told that, look, if you bring in, we would give you a return. If I ask for my money within 1 month, how much is that return? And yet I can access it even on phone because of technology. So I'm not throwing away saying the opportunity is bad. There is a prescribed return that you'll get, but only if you save in there long term. But does it make sense to save in money market long term? I doubt, because the return is not as high, given that they guarantee you that your capital will not depreciate. Their return is not as high. So if their return is not as high, there are opportunities elsewhere. For example, in infrastructure bond or bonds, you could put money yourself in those bonds and get higher returns long term instead of investing long term in a money market. No, don't invest long term in a money market. Yet, if you want to make money from the same, you may have to go long term. There are better opportunities for long-term investment than money market. Sorry, I had to bring in that just to explain the difference between saving and investments, and the reason why we need to be even more informed as investors, because it's about us as a country, it's about us as individuals, as households. Thank you.
Thank you so much, Crispin. I'll give the vote of thanks on behalf of the Institute of Economic Affairs. Thank you so much for taking your time, Mr. Oduma, for being here with us and educating us. Personally, I've learned a lot. In fact, now I have been challenged to go back to the finance bill and look for those sections, because it seemed like I didn't see them the first time. So thank you for that. And I'm sure the other participants would also agree with me that it was very enlightening. Thank you for our participants. I can see a few of them have dropped off, but we will send our thanks via email as well for attending this webinar. And with that, I want to wish you all a very good day. And for those of you who are not members, please reach out to Michelle Onditi and she'll assist you in being part of the IEA family. Thank you so much.